Imagine you are navigating your finances in a new country where every dollar counts and sometimes unexpected bills pop up. You want to make sure your payments go through, but you also want to avoid any surprises that could strain your budget. One tool you might encounter is called overdraft protection. For new accounts, overdraft protection can be both a helpful safety net and a potential source of expensive fees. The truth is, whether it is good or bad largely depends on your personal financial habits, your available funds, and your ability to monitor your account regularly. It is not inherently good or bad, but rather a tool that requires careful consideration. The core mechanism of overdraft protection allows your bank to cover a transaction that would otherwise cause your account balance to drop below zero. This means your debit card purchase or check will still clear, preventing potential embarrassment or additional fees from the merchant you are paying. However, in exchange for this convenience, banks typically charge an overdraft fee, which can range from $25 to $35 per occurrence. These fees can quickly add up, turning a small overdraft into a significant cost. There are different ways this protection might work. Some banks link your checking account to a savings account or a line of credit. If you overdraw your checking account, funds are automatically transferred from your linked account to cover the difference, often for a smaller fee than a traditional overdraft fee, or sometimes even for free if it is from your own savings. For debit card transactions, federal law gives you the choice to opt in or opt out of overdraft protection. If you opt in, your bank will process the transaction and charge you a fee. If you opt out, your card will simply be declined, preventing the fee but also the transaction. To decide if overdraft protection is right for your new account, start by understanding your bank's specific fees and policies. Ask if they offer different types of protection, like linking to a savings account, which is generally a much more cost-effective option. You should also consider your spending habits. If you tend to keep a very close on your balance and rarely make unexpected purchases, you might choose to opt out of the standard overdraft protection to avoid fees. On the other hand, if you want the assurance that important bills will always be paid, even if your balance is slightly low, then having a linked savings account could be a smart move. A key insider tip is to prioritize building a small emergency fund in your savings account. This serves a similar purpose to overdraft protection by covering unexpected shortfalls, but without incurring bank fees. Also, many banks offer text or email alerts when your balance is low, which can be an excellent way to prevent an overdraft before it happens. Understanding these options empowers you to choose what makes the most sense for your financial journey in the United States. Ultimately, making an informed decision about overdraft protection for your new account is about balancing convenience with cost. By understanding how it works, exploring alternatives, and staying proactive with your account monitoring, you can leverage financial tools wisely to build stability and confidently manage your money without unnecessary stress.